Today in our review for the Series 6 exam, we are going to break down one of the most fundamental concepts for mutual funds, the calculation of net asset value, or NAV. This is a topic that is guaranteed to appear on your exam, so understanding its mechanics is non-negotiable. The core of NAV is its formula, which is the fund's total assets minus its total liabilities, all divided by the number of shares outstanding. Think of it like a company's balance sheet, but for a fund and on a per-share basis. The assets are everything the fund owns, primarily the current market value of all the stocks, bonds, and other securities in its portfolio, plus any cash. The liabilities are everything the fund owes. This includes accrued expenses like the manager's fee, custodian fees, administrative costs, and any other operational bills that haven't been paid yet. Once you subtract what the fund owes from what it owns, you get the net assets. Dividing this number by the total shares held by all investors gives you the value of a single share. For example, let's say the Open Exam Prep Fund has a portfolio of securities valued at $100 million. It also has $2 million in cash. Its total assets are $102 million. The fund owes $500,000 in management fees for the period, and another $500,000 in various operational expenses. That's a total of $1 million in liabilities, so its net assets are $101 million. If the fund has 10 million shares outstanding, you take that $101 million and divide it by 10 million shares. The NAV per share is $10.10. This calculation is not just a theoretical exercise. The Investment Company Act of 1940 requires mutual funds to calculate their NAV at least once every business day. This almost always happens at the close of the major U.S. stock markets, which is 4 p.m. Eastern Time. This leads us to the next critical concept tested on the exam, which is forward pricing. When you buy or sell a stock during the day, you get the price at that very moment. Mutual funds do not work that way. All purchase and redemption orders placed throughout the trading day are queued up and executed based on the next NAV calculated after the order is received. If you place a buy order for a mutual fund at 11 a.m., you do not get the NAV from the previous day, nor do you get some intraday value. You are locked in to receive whatever the NAV is calculated to be at 4 p.m. that same day. You are buying the shares blind to the final price. This is a massive trap for test takers. A common question will describe an investor placing an order at 1 p.m. when the last calculated NAV was $50. The market rallies in the afternoon, and the new NAV is calculated at $51. The question asks what price the investor paid. The answer is $51, the forward price. The price at the time of the order is irrelevant. To help you remember this, use this simple phrase. You get the price that's next in line, calculated at the market's close time. This mental shortcut reinforces that investors always get the next computed price, not the one they see when they place the order. The exam will test your understanding of this timing. It also distinguishes between the price an investor receives versus what they pay. The NAV is the price an investor gets when they sell or redeem their shares. Buyers, on the other hand, pay the public offering price, or POP, which is the NAV plus any applicable sales charge. So, while the NAV is the base, the final transaction price depends on if you are buying or selling.